So we hear a lot about commercial real estate right now, not all of it good. A lot of focus on office buildings. But we've learned that commercial real estate is more than just office buildings. It's part of it, but not all of it. Give us a sense overall how commercial real estate is doing.
Well, of course, office buildings are the most difficult part of the commercial real estate story today. When you look at other asset classes, so for instance, industrial buildings, which is a big asset class, medical office buildings, hotels, life sciences buildings, multifamily, institutional quality apartment buildings, basically very strong fundamentals. And when I say fundamentals, I mean the following. Well leased, in fact, some of them historically well leased, strong rental rates and upward pressure on rental rates in a lot of cases, not a lot of new supply coming on. That's what we mean by fundamentals. And when you get beyond office buildings, the fundamentals in the commercial real estate group of asset classes are generally very strong. And even within office buildings, there's a slice of office buildings, I'm going to say 30 to 40% of them, these newer, better configured, better infrastructure office buildings where companies are trying to create a really high quality experience for their employees to get them back in the office. Those assets are doing quite well. So the headline grabbing stories of an 80% vacant office building, that's an anecdote. That's not a proxy for what's going on in commercial real estate.
So when you talk about the newer buildings, we're learning to call them A's or A pluses as opposed to B's and C's.
Yes.
But if you take a look at commercial real estate, the office portion of it right now, how much of it's A, how much of it's B, how much of it's C would you say in general?
Yeah. Well, I think if you look at true A or A plus, it's maybe a quarter of the space out there. But you could go down a little further and have some very nice buildings that, if upgraded appropriately, would be true A's. And then you probably have the bottom quarter or so that are real problematic buildings that are either going to have to be mega redeveloped or probably scraped and turned into land sites. And then in between you have a variety of different kinds of buildings, some of which can be repurposed maybe into multifamily, although that's very difficult to do. Some of them will be upgraded to Class A buildings, and some of them will go the way of land also.
So you have different parts to commercial real estate, and then within the office part of commercial real estate, you've got different classes to look at. What about geography? Because another thing that we have heard is that it depends on what metropolitan area you're talking about. San Francisco may be troubled. New York, maybe not so great. Chicago, but then there are others, whether it is Miami, for example, some parts of Texas are doing pretty well.
Well, you mentioned San Francisco first. So that's probably the toughest story out there in office buildings. And it's for more reasons than just the tough to get people back in the office. First of all, everybody knows that's where so much concentration of tech occupancy is. Those companies have laid off a lot of people. But David, think about this. We all know that the technology companies that are going backwards with headcount now are going to go the other direction for sure in the long run. We know that's going to happen, and that part of what's going on is going to come back. And then, of course, you do have the cyclical thing with the economy being down a little bit, and you have the secular thing with people not being back in the office as much, and technology companies kind of led that charge. But by the way, if you see what's going on now, the technology companies are talking about getting their people back into the office.
Talking about it, but are they getting that done? I mean, we just this week passed the milestone in New York of 50% occupancy, and that is by use of the sort of security cards so they know they're actually in the office. Is it ever going to come back to where it was before?
Well, New York is a good example of quite a bit of the spectrum of what's going on. So in Class A, top quality buildings here in New York, you go over to Hudson Yards, or you go to One Vanderbilt in Midtown across from Grand Central Station. These buildings are doing well, and they're going to continue to do well. And they're doing well because they create a great story for the client or for the tenants and their people, a great experience for their people. Other buildings are suffering more because they don't create that experience, but they're all slowly filling up. We did see a flat spot for quite a while. I'm going to say from earlier this year till about now, but we're starting to see it rise a little bit again now, and you really are seeing a push from companies to get people back in. I do not think it's going to go back to where it was, and in fact, the work we've done would suggest that in the long run, companies are going to take maybe 80% of the space, maybe as little as 75% of the space as they previously had.
As you mentioned, there's the financing aspect as well. We read a lot right now about maybe some arrears building up, maybe some concern about needing to refinance this year. What is the situation in financing of office buildings right now? What are the risks out there?
Well, we've looked at that everywhere you can imagine. I'm going to start with banks. So you've heard a lot, we've all heard a lot because of some of the bank challenges we had a couple months ago that commercial real estate was going to put a lot of pressure on banks. And office buildings in particular were going to put a lot of pressure on banks. The facts are about 1.5% of bank assets are in office building loans, 1.5%.
And that's all office building loans?
All office building loans. Now, we think that there is going to be some jeopardy among that portfolio of loans, but we think it's going to be like 25% of those loans. So take 25% of 1.5%, and you can see that the banks aren't going to have a really big problem coming from commercial real estate. They will have some problems. They will have some loans that need to be restructured. They'll have some foreclosures. We know that some of that's going on already. But again, this headline, this anecdotal-driven, sensationalized headline about all the crashing down that's going to take place, it's really overstated.
Putting aside crashing down, there are some adjustments going on. How far along are we in that adjustment period, particularly with respect to valuations? Obviously, valuations come down, both because interest rates are going up, so it's more expensive to finance things, but there's somewhat less demand for at least some office buildings. Where are we on that adjustment of valuations?
Well, I mentioned all those asset classes earlier in our discussion. Values have come down for all those asset classes. And the reason, one of the real drivers of that is the cost of debt goes up. When the cost of debt goes up, it's more expensive to leverage your buildings. The value of the equity goes down. Office buildings have gone down the most. The other asset classes may have gone down 10, 15%. Office buildings maybe as much as 30%. We do think that the decline in values has kind of run its course and will stabilize now and will start to come back later this year. The fact of the matter is interest rates have stabilized. We think they're going to start to come down. Inflation appears to have peaked. It's coming down. And so we think the decline in values has kind of played out.
So I don't want to put words in your mouth, but I think what I'm hearing you say is, by and large, looking at as far as you can, you think maybe the market has largely discounted what it needs to discount at this point.
Yeah, I think that's probably the case. Now, we all need to figure out what's going to go on with the economy. Right now, the economy has performed better than we thought it was going to perform, quite a bit better around the world. In fact, there's now an expectation that we won't even have a recession in Europe. If we ended up with a worse recession than we think we're going to get, values would come down further because people would stop spending money of all types, including try to spend less on rents. But we think values have kind of hit the bottom, are going to start recovering, and we believe that we're going to have a mild recession that's going to take place later this year, be relatively short, and you'll start to see things come back. By the way, there is a massive amount of capital on the sidelines that wants to invest in commercial real estate. And there is a massive amount of real estate that wants to be refinanced or sold, and everybody's uncertain about what's going on with values. And as soon as we have some certainty, as soon as we think interest rates have peaked and are coming down, you'll start to see those assets trade and get refinanced.
As in so many places, you need the buyer and the seller to agree on that price.
Yeah, and you need them to be confident that it's kind of gotten where it's going to get to.